Welcome to Athena. Today we will discuss the stock market and how you may get started. What happens when a large number of people enter the stock market? People invest their money, and their wealth is occasionally destroyed as a result. They inform everyone that the stock market is similar to gambling, that it is impossible to profit from. However, if you conduct an extensive study, give your investment some time, and retain your investment for a lengthy period of time, you will be rewarded. Then you may become a successful stock market investor. This is the first video of a series on the stock market for novices. In which case, if you're interested in the stock market, but don't know anything about it, we'll teach you how to become a smart investor from the ground up. Let's get started with today's video. First, let's talk about the market. In any market, there will be two parties who exchange something for something else. Similarly, there are two sides to the financial market. One party that needs funds to operate its company. Secondly, there is a third party that has additional money that has to be invested elsewhere. Assume there is a corporation that requires funds to operate. It uses the financial market to obtain funds from investors, which it then uses to conduct its company. How does the investor transfer these funds to the company? How does this transaction take place? This transaction occurs in two stages. The first technique is to share. Assume a corporation is valued at $100. It consists of 10 shares. As a result, one share is worth $10. The corporation sells its 2 shares to raise funds. Because 2 shares were sold, one investor paid $20 for the 2 shares. In this manner, the corporation gives away its shares while the investor pays for those shares. A peculiarity of the stock market is that for each share purchased, an investor receives a particular proportion of ownership in a firm. They become owners of a portion of the firm based on the number of shares they purchase. The second way is to incur debt. Debt, such as when we take out loans. Similarly, businesses take out loans and pay interest on them from time to time. After a certain period of time, they must pay the entire principal amount. You're probably wondering why the investor purchased this company's stock. What advantages does it provide to the investor? Purchasing shares might help an investor in 2 ways. First, there is price growth. To put it succinctly, the initial investor paid $10 for the company's stock. Assume the share price doubled and reached $20. As a result, the investor profited $10 on each share. This is referred to as share price appreciation. Second, which investors like us frequently overlook. However, dividends are significant. What exactly are dividends? Assume that the corporation, after a year of operation, the company realized a profit of $140. The corporation set aside $50 out of a total of $140 for future growth. So how much of it is left? This profit of $90 is then divided among the stockholders. Assuming the corporation has 10 shares, each shareholder then receives $9. This is known as the dividend. To clarify, out of its earnings, the amount remaining after subtracting what the firm preserves for future development is split among the shareholders, and the fraction each investor receives is known as a dividend. One feature of dividends is that it is fully up to the firm to determine whether or not to pay out dividends. Because many corporations do not pay dividends, it claims to reinvest all of its revenues on itself. To give you an example of price appreciation, consider MRF shares. The shares were once worth $20. Those that acquired it at the time saw it climb to nearly $1,000 at some point. Many instances spring to mind when we discuss price appreciation. However, we do not place enough emphasis on dividends. Let's speak about a business, shall we? This company has sometimes given dividends to its shareholders. Because dividends are a valuable source of income. And it is something that investors should pay more attention to. Hasbro Inc. is a good example of a dividend-paying company. Hasbro's current share price is about $100. And this corporation has already handed out thousands of dollars in dividends to its shareholders. So you can picture how much profit you may make from dividends if you select a firm that pays out high dividends. If you're still puzzled about dividends, they are paid straight into your bank account whenever a firm declares a dividend. If I were you, I would believe that I knew how dividends profit from the corporation. But how can a company's stock price rise? How can a company's share price grow? What is it that causes the price to rise?
Stick around for part 2, where we will discuss exactly how you can get rich from the stock market. Please like and subscribe and leave a comment on anything else you think we should cover. See you next time.